Broadcasting. Hello, good morning and welcome to Marcellus' first ever quarterly webinar. I can understand it's a Saturday morning. Many thanks for all of you to joining in. And we would like to touch upon a couple of things this webinar. The first one is, of course, we'll take you through what's happening with the portfolio, a little bit about the performance, and more importantly, the underlying fundamentals, what we're seeing in terms of the earnings trajectory that we've been tracking. And also in the second section of today's webinar, we'll touch upon something that's perhaps one of the most frequently asked questions about our philosophy, which is the valuation in the high Ps. So without further ado, I'll welcome my colleague and fund manager Rakshit Ranjan to take you through the portfolio.
Hi, good morning, everyone. Thanks for dialing in on a Saturday morning. So a quick overview of the portfolio. So our portfolio consists of around 12 stocks. Since inception, that's been the count. The only change in the portfolio since inception has been Group Finance, which used to be part of the portfolio. We exited Group Finance on the morning of 8th of January. Overnight, after having understood that our clients' portfolios will get Bandhan Bank's shares in exchange for Group Finance shares, thanks to the selling of Group Finance to Bandhan by HDFC Limited. We didn't want our clients to hold Bandhan Bank shares, and hence we made that change. Other than that, nothing else has changed since inception. The inception was, by the way, on 1st of December last year. Since then, the portfolio has delivered about 3.5% absolute return versus Nifty of about 5-odd%. The earnings growth expected in the current year for the portfolio companies is about 20%. Average return on capital employed about 30%. So fundamentally looking pretty good as expected. Going forward, we continue to expect 20 to 25% share price return for the overall portfolio for our clients on an annualized basis. The one big stock to highlight in terms of the performance on the negative side, there were quite a few on the positive, but just to highlight one outlier on the negative side, Page Industries is part of the portfolio. It's one of the larger holdings. It has corrected by about 12.5%, 13% since inception. The stock price is down by 12.5%, 13% since inception. There were a few reasons behind it. There was one large seller on Page exiting in the month of December, January, which was Nalanda. They held 10% of the company. That was then followed by a relatively moderate growth in the quarterly numbers, where revenues grew by hardly 15-16% versus long-term historical run rate of 25-30%. And that was followed by one of the brokers calling out some sort of an accounting issues with Page. We subsequently delved deeper and were very comfortable that there is actually no account issue here to begin with. The fundamental weakness in the quarterly numbers, we believe, is completely temporary. We do not think Page is losing market share. In fact, whatever the reasons for fundamental weakness are, they're more related to the supply chain channel, macro, etc., which are all temporary factors. And within a quarter or two, hopefully, you should actually start seeing recovery from this from the March quarter onwards itself. So that's the reason why, despite a little bit of negative media around the company, we've been quite comfortable holding on to Page Industries. But that specific aspect, the fact that one of our largest holdings in the portfolio, it delivered a minus 12-13% share price return in a very short period of time, is something which I thought is worth linking with the philosophy of consistent compounders as well. So I'll spend 5, 10, 15 minutes approaching the philosophy in a slightly different, very interesting, and certainly very, very simple manner. So if you just keep going with me on the slides, you'll see how interesting and simple investment under this philosophy is. So as you know, our portfolio is a very concentrated one. The top stocks in the portfolio are the likes of Asian Paints, HDFC Bank, Nestle, which are pretty large, very deeply moated franchises, we believe. However, one of the most frequent asked questions from our clients about the philosophy is around valuations and market timing. As in, why do we see no value in trying to enter into our portfolio companies at cheap valuations, and why don't we try to exit at expensive valuations, waiting for the valuations to correct again? Now, market timing valuations is a practice followed widely around the world under a classical value investing paradigm, I would say. So in this webinar, let me take you through a few slides to delve on this matter in a little different way, which will actually help answer these questions around why don't we try to time markets and time valuations. And we'll limit ourselves only to mathematics, because everything else can be debated, can be questioned. Mathematics is pure, simple. There's no debate around it. So rather than using science behind investing, we'll use mathematics behind investing. So let's move to the next slide. On the slide screen, you can see a very simple and non-debatable equation. Yeah. So the equation says that the share price of any company is a product of its PE multiple and earnings. Yeah. The PE multiple, interestingly, does not compound over a period of time. Yeah. In fact, the PE multiple of most stocks indices, it largely doubles or halves over a period of time. So Sensex, Nifty would see their PE multiple go from 13, 14 times at the bottom to 26, 28 times at the top. HDFC Bank would oscillate between 20 times PE multiple at the bottom to 40 times at the top. You would rarely, or actually you would probably never see PE multiples oscillating between 5 times at the bottom to 100 times top, right? So it's largely a doubling, halving of PE that we see for indices and stocks. Now, when you look at the second factor in the equation, which is earnings, earnings keeps compounding over time. So if you do have companies which keep growing, earnings will become 10 times, 100 times, at times 1,000 times bigger over a period of a few years or decades, which then, in a way, this is a different variant of the same equation, that to get a share price change from your investment in any stock, right, you have to get a combination of PE multiple change and earnings change, right? Now, if you look at the three classifications of companies which have come up on the left hand side of your slides, yeah, so let's divide the Indian stock market into type A, type B, and type C stocks. So type A stocks, they comprise around actually 80 to 90% of the Indian market. These are companies which find it difficult to grow earnings over extended periods of time. Yeah, I've taken the example of companies in Indian. So I've taken the example of sectors like telecom, airlines, right? These are companies which have never-ending volume growth. They keep flying aeroplanes, they keep adding subscribers to their telecom networks, but there are no earnings growth, right? Because they have no sustainable competitive advantages, and hence the earnings don't compound much. The second type of stocks that exist in our country are the type B, which we call as, you can refer to them as B for Buffett. These are these are actually good companies. Yeah, they are good companies. I've given a couple of examples here. Maruti and Hindustan Unilever are some examples of these. They have meaningful competitive advantages, and as a result, they do end up growing their businesses. However, the growth in these businesses is no more than, say, 12 or 13%, which is pretty much the same rate as nominal GDP growth. And on a cycle basis, rate that Sensex or Nifty also deliver in their earnings, which is about 12-13% growth over a decade-long period, let's say, annualized basis, right? Why do we call this as B for Buffett? Well, these growth rates of earnings are similar to what you would get in very good quality companies listed in the US markets, in the UK markets, etc. And as a result, what Warren Buffett has actually tried to do is pick up these stocks. And type A plus type B together, they comprise of 100% of the listed universe of the US markets or the UK markets. In India, interestingly, there's a type C as well. So we'll come to that in a minute. But let's first see how the equation of share price movement evolves around type A and type B. So what you now see is an equation where you've got on the extreme right side earnings growth of type A being 0. And as I said, the PE multiple at best would double over a decade-long period. So let's say you have a fund manager. Who can time investments in type A companies so well that he goes through the doubling of the PE multiple while he holds the stock in the portfolio, right? Now, doubling over a 10-year period is a positive 7% CAGR. And hence the PE multiple change annually is contributing to 7% positive to this equation. Your share price outcome is also a plus 7%, and you've got a unhappy smiley on the right because plus 7% is no greater return to be derived, even though you have timed the PE expansion very well, right? What happens if P by E multiple halves? Well, with 0% earnings growth, let's say over a decade, which actually is something that many telecom companies have delivered in the country, many airline companies have delivered. With 0 earnings growth, halving of PE multiple leaves you with minus 7% share price return, which again is a very, very unhappy situation for any investor to be in. If we come to type B, this is what great investors in the Western world have successfully done. They get 12-13% earnings compounding. They see significant PE expansion during their holding period, and they end up delivering around 20%, 19-20% share price compounding, which actually will make you very healthy over a 10-year period, and hence it's a very happy outcome for investors. Let's see what happens if PE multiple halves on the on your portfolio of type B companies. So if in a Maruti or a Unilever, you capture halving of P by E multiple and the company is delivering a 10-year earnings CAGR of only 12%, you are again getting a very unhappy outcome of positive 5%. So in a way, as I said, type A plus type B is 100% of US markets listed universe. And the type B equations quite clearly tell you that timing of P by E multiple becomes very central to defining a happy or unhappy outcome as an investor, right? So timing of P by E multiple is very important. This is what is the conventional value investing paradigm that we all know about, and hence it makes a lot of sense. Now let's just come to type C. So first let me explain what really are these type C companies that exist only in India, not in any other large economy globally. Now these are the companies where the competitive advantages are so strong they generate such vast free cash flows that they are able to not only return a very generous dividend to shareholders, but also reinvest these cash flows in growing their businesses whilst retaining the competitive advantage of these businesses. So the likes of Asian Paints, HDFC Bank, they've ended up as a result delivering 25%, 27% earnings compounding over 10, 15, 20 long years, unlike the Hindustan Unilevers of the world, unlike the Marutis of the world. And that, in a way, is what we define as consistent compounders. Now, with a Type C firm, if the fund manager is able to get the timing of his entry and exit right, as in if he can capture the doubling of P by E multiple, the equation that you see on your screen shows you that with 25% earnings compounding, you get a 7% icing on the cake, and you compound your share price at 32% annualized, which is obviously a very healthy outcome, will make every investor very wealthy. But let's also see what happens if you don't end up timing the PE multiple well, right? Halving of P by E multiple on your screens, it shows you will still deliver a 18-19% share price return. And mind you, these share price returns don't include the dividends. So whilst a telecom or an airline company will not be able to give you dividends, the Type C companies will give you about 2% dividend yield. So you can add a layer of 2% on top of what you see on the screens here. In a way, what this simple comparison is telling you is that if you invest in Type C companies, the strength of the earnings growth make multiple timing a redundant exercise, because your outcome is happy regardless of whether you time the P by E multiple expansion well or whether you undergo compression in the P by E multiple on your portfolio. It's the 25% compounding of earnings, the strength of that 25%, which makes the outcome indifferent in terms of happiness and wealth creation on your portfolio, right? So that's in a nutshell what we are aiming to do. With consistent compounders, we are trying to build a very concentrated portfolio of companies of Type C, and the best and most recent example is Page Industries. Here again, I'll refer to it. Although in a very short period of time, we've seen a compression in its PE multiple, as long as we are correct in predicting a 25% compounding of Page Industries, your outcome of the share price will not be a disappointing one, regardless of where the PE multiple goes. And also, mind you, I don't think there is any science which can give you a very high probability of predicting the PE multiple. So theoretically speaking, obviously there's a difference between 32% and 18%. But practically speaking, since the timing of PE multiple is possibly just as good as a toss of a coin, it's not possible. It's not actually worth chasing the plus 32 versus plus 18, because both outcomes are pretty good. Now let's come to the interesting thing about this. So why is this Type C companies equation so simple and yet not very commonly found, not very commonly followed? Why do people in India as well keep trying to time PE multiples if you have Type C companies as options available to you, right? That's because it's not too easy to do two things about the Type C investing, right? The first thing is forecasting the change in PE multiple is like deriving excitement out of investments. Yeah, many fund managers, many investors would not believe that they can add enough value to their investments if they could not forecast P by E multiple movements, or if they could not forecast whether Narendra Modi comes or doesn't come in the general elections, and if he comes, will the stock market go up or not, and if the stock market goes up, will their share prices of portfolio companies go up or not, right? That layer of forecasting of PE multiples at various levels for the market, for the stocks, is utter excitement. It is good to have excitement in your life, but in a way, when you do type C investing, by making the P by E multiple redundant, the strength of the earnings growth is in a way making the investment exercise very boring, right? And boring is obviously not too easy to do. It is very simple, but not too easy to do. The second challenge is forecasting a change in earnings over a long period of time means understanding of fundamentals to a very deep level. Now, if you are trying to build conviction on a company to be able to deliver 25% earnings compounding for 10 long years into the future, you have to undergo a lot of rigor in your research, in your understanding of the firm, in your understanding of why, despite too many disruptions and evolutionary changes, this company will not give you a weak earnings outcome over a 10-year period. Why, despite the fact that there will be too many political party changes, too many macroeconomic changes, management teams of these companies will change, why you should still be able to back the earnings expectation of 25%, right? That requires a lot of rigor, a lot of hard work. In a way, this really is the value add that we as Marcellus are trying to bring to your portfolio via investing in type C, by first of all pulling out the excitement from the portfolio, making it very boring and hence very less volatile, but also making sure that the earnings compounding is healthy enough for you to keep compounding your wealth over a long period of time, rather than just giving you a great 3, 6 month or 9 month outcome on the portfolio, right? So that's the main reason why, because it's boring and because getting the conviction on 25% is not an easy job. That's one reason why it is very simple to understand that investing in HDFC Bank and Asian Paints types of stocks will actually give you the best compounding with the least volatility. It's very difficult to implement, and hence we believe we can give our investors 20 to 25% compounding of the portfolio with the volatility akin to that of a government bond. Yeah. Now, here are some examples of how this concept of earnings making P by E multiple redundant has actually worked in the past. So on the screen, you can see the period of 1994 to 2004, and I've given 4 of our portfolio companies which were consistent compounders even 20 years ago, 25 years ago. You can see that Asian Paints, ITC, Pidilite, Nestle, they were all trading at PE multiples very similar to their current PE multiples. Yeah. A decade later, their PE multiples were roughly half of their 1994 levels, right? And the share price outcome was still pretty robust, 13-14%. Add dividend on top, it would have been 16-17%. That's the worst you have seen in the PE multiple compression in the entire history of Indian stock markets for type C companies, right? That's the worst outcome possible over the last 30-35 years. If you are utterly unlucky, that's what you're gunning for. But remember 2 things. One, in an absolute way, you'll still be compounding at 15-16%, including dividends. In a relative way, this will still be the best asset class. Within the equities, it will be one of the better portfolios. And broader wealth compounding, this will still be one of the best asset classes, because you can see what happened to Sensex on that table during the 10-year period from 94 to 2004. So that's an example of how compression in PE has in reality affected type C companies in the past, and that's the worst case scenario that history has taught us. This is in a way the best case scenario that history can teach us. The second table at the bottom of the slide there, which is Page Industries, going from 23 times P/E multiple in April 2008 to 81 times P/E multiple in April 2018. I've purposely taken April 2018 here because it's actually before the crash, so it gives you an even extrapolated example of P/E expansion. Intuitively, someone would believe that 45% share price CAGR would be largely driven by the P/E multiple expansion. But what you see here is that earnings contributed to as much as 80% of Page's share price growth, despite the fact that the P/E became almost 4 times over a 10-year period. So again, in a way, what this equation is saying is that had the PE multiple not expanded, Page would have still delivered a 30-35% share price compounding. And let's stretch it to the other extreme. If the P/E multiple compresses, let's say if it halves again or if it becomes 1/3 over the next decade, you will still get a healthy 20-25% share price compounding, provided the earnings compounding remains at 25-30% levels, which we believe the portfolio that you hold into will keep delivering. So that's really in a nutshell historical examples. So I'll stop talking here. Happy to take any questions that you might have, either on the philosophy or on the portfolio. So open the floor to questions. Should I keep taking this up? So I can see a question which says, what I see in my portfolio, paints, chemical, footwear, industries have been given more exposure. Do you think of better prospects that these sectors may have? So it's a very interesting question. Let me summarize it like this. Paints in India has got a very, very tight construct. Thanks largely to Asian Paints. The tightness of the construct is such that any firm doing, actually any firm which can even survive in paints in the country is likely to deliver a very deep-rooted moat to its investors. So let me elaborate on it a little bit. So if you look at Asian Paints, yeah, it's a voluminous product where, without going into too many details, let me come to the summary of the moat. The summary of the moat is that there are no layers of distribution between the manufacturer and the paint dealer on the high street. There are no wholesalers, there are no distributors, no CNF agents, etc. Paint companies supply directly to the paint dealer on the high street. And at the same time, the paint dealer on the high street gets hardly 3%, 4% channel margin, right? So there are no layers in the channel, and the channel margin is very thin. What that does is, when the dealer decides to stock a particular product, and honestly speaking, whatever the dealer decides is what the painter pushes, and that's what you buy as homeowners, as customers. Whatever the dealer decides is based on how quickly a company can deliver products to the dealer. So if a dealer has voluminous product and hence can't stock a very high value of inventory in his shop, and on that low value inventory, he ends up getting hardly 3% channel margin. The only way for the dealer to make money is do inventory turns at a very high rate. So in a place like Colaba, which is a landlocked area, in Colaba, Asian Paints delivers 4 times a day, Berger delivers twice a day, Kansai and Akzo deliver less than once a day, and that really is the moat of Asian Paints. The moat comes from demand forecasting that Asian Paints does, and the supply chain efficiencies that Asian Paints brings about. The nature of the moat is such that nobody else can replicate this moat overnight. And in a way, what Asian Paints is doing is a very different job than a usual brand distribution company. For instance, a Unilever is just about brands and maybe width of products. Likewise for Maruti, but Asian Paints is delivering a logistics company to the dealer. To us, it's a paint company, but inherently, it's a logistics company. It's an Amazon built over 50 years, better than the Amazon of today, in a very, very difficult category, which is voluminous in nature, with too many SKUs, etc. Right? The nature of the moat here is such that for the last 6 decades running, Asian Paints has grown revenues only at about 20% annualized, never at 25, never at 15. Right? That's the robustness of the moat. We believe there is no other sector in the entire country, no other sector in the entire country where the depth of the moat is as strong as that of the paint industry's leader, Asian Paints, right? Now, once Asian Paints does that, the reason why we also have Berger is because Berger ensures that it maintains the same run rate of supply chain progression over a period of time, although it is, I would say, 5 years behind Asian in absolute level. But in the relative level, it doesn't let the gap between Asian and Berger expand. On top of it, the current CEO, Mr. Abhijit Roy, he keeps doing a few extra layers of innovations every now and then to ensure that Berger not only survives in such a tightly constructed industry, but it actually also delivers an outcome very similar to that of Asian Paints. And Pidilite's story is actually very similar as well, where alongside just supply chain and channel connect, Pidilite actually does product innovation as well, which you don't find in Asian Paints. So along with product innovation, it does excellent branding and advertising as well, which was not needed in paints. So when you combine these three, Asian, Berger and Pidilite, in a way, I know you are exposed to only one sector, which is home building materials. Some people might call it chemical companies. We use the BSc classification, which calls it chemical companies. But in a sense, what you are doing is you are exposing yourself to the most deeply moated industry. No other industry comes close to this depth of the moat. And hence, rather than treating it as too many eggs in the same basket with 3 stocks and roughly 33% exposure to one area of the industry, I consider this as actually the reason for safety, the reason for downside protection, the reason for low volatility in your portfolio. So these 3 companies together will probably give you the least volatility across all other companies in this portfolio and across probably pretty much the rest of the listed universe. These 3 companies will give you the least volatile outcome, the fairly healthy about 20% compounding. That's the reason why we hold them. Okay, quite a few. Okay, so one of the participants is asking the portfolio of people entering at different times, will it be the same or different? So the portfolio, the list of companies will be exactly the same, but because we are not in the practice of rebalancing every now and then, it is possible that somebody has Asian Paints as 11% of the portfolio and another guy has 10.5 or 11.5. So there might be minor deviations from one client to another. The quantum deviation will be negligible. List of stocks will be the same at all points of time. If we decide to sell anything from the portfolio, we'll make the change across all existing companies, all existing clients and all prospective clients as well. Okay, so I'm taking the next one, which is on ITC. Are you convinced that smoking habits will not shrink in the future? There was a global adult tobacco survey that showed that smoking prevalence declined in India between 2011 and 2017? Yeah. So first of all, very good question, I would say. First of all, when it comes to smoking per se, especially when it comes to BD plus cigarettes, we are utterly convinced that the shift that BDs will provide gradually to cigarettes and the penetration geographically and frequency of consumption of cigarettes in the consuming population will at least give a 2 to 3% positive volume compounding, positive volume growth, plus 2 to plus 3% over the next 10 to 15 years for the cigarette industry, and ITC being a monopoly will also see pretty much the same run rate. Now you're right, 2011 to 17, cigarette volume growth rate in India was -3, -4%. There was a decline. The single specific reason for that was 2012 to 2016. You saw 4 consecutive budgets from the government of India hiking tobacco excise taxation by as much as 20% each year, which then led to ITC being forced to take consequent price hikes of about 18 to 20% because it is a very high pricing power company. There was a temporary drop in volume growth rates for those 4 or 5 years, but last year and a half or so has already seen the volume growth coming back into very healthy single digits. So last 3-4 quarters, ITC has grown volumes at about 5 to 7% positive. Right, so it's reversing the trend, the trend of 2011 to 17. Also, because cigarettes were becoming expensive, it's not that people stopped consuming tobacco. The prevalence of BDs and chewing tobacco had increased over the last decade during that period of cigarettes becoming very expensive. So it's not that people were moving away from the sinful category, just the format of consuming tobacco had changed. Going forward, as I said, low single digits volume CAGR is likely for cigarettes overall. Okay, so I'm taking the next one. Given the already huge size of HDFC Bank, book value and market cap, do you still think it has the runway to continue growing 20 to 25% in earnings or book value growth? So, okay, so again, a very good question. One of the apprehensions that most clients will have in all our stock holdings in the portfolio will be the size. And hence, aren't these 2 matured companies already to grow from here on? First of all, let's take an analogy of Asian Paints, which has a much longer historical track record than HDFC Bank. Asian Paints grew at 20-25% when it was 100 crores, when it was 1,000 crores, 10,000 crores. Today, it's about just under 20,000. And still it is growing as recently as last 9 months of this financial year, last 3-year CAGR, last 5 years. You see Asian Paints is continuing to grow. That's one point. Why is that? Well, the industry kept growing and Asian Paints was always a very dominant player. A little bit of market share gain is what Asian Paints has got. Now, when you do HDFC Bank as an example, the interesting thing is HDFC Bank's market share. I mean, you can slice and dice the market into relevant, irrelevant areas, etc. HDFC Bank's market share is significantly lower than what Asian Paints types of companies also have. HDFC Bank is not a 50% market share already. That's one. Secondly, the financial sector, the banking industry is no close to being saturated. In fact, financial inclusion has only accelerated very recently. If HDFC Bank's moat, the competitive advantage, continues to play out the way we expect it to, right? We have no doubt whatsoever that HDFC Bank will keep compounding at 20 to 25% over the next 5, 10, 15 years. It is not a lender really. Lending and disciplined lending comes later. Just like Asian Paints is a logistics company in the form of a paint industry, HDFC Bank is a CASA franchise. CASA is current account, savings account. because the CASA franchise gives it a very low cost of borrowing, it does not have to indulge into high risk lending. Hence, that's in a way, in a nutshell, the moat. There is no reason why this moat should see dilution in the foreseeable future, according to us. And as long as the macro runway, because of low market share and financial banking sector continuing to grow, because the macro runway is long enough, we have very high degree of conviction on HDFC's ability to keep compounding. What question should we take next? So the next one I'm taking up is, how do you decide on the ratio of portfolio companies? So this decision is based purely on our conviction on the fundamentals. So even within our 11 or 12 stock holding portfolio, we would have top 3 stocks by conviction, next 3, the last 3, etc. Our coverage universe is hardly about 25 companies. Within those 25 companies, we do have a gradient of conviction. We tend to hold 10 to 15 companies in the portfolio basis the risk reward that we want our clients to enjoy. But because we have a gradient of conviction within the 11 or 12, the allocations of specific stocks are also accordingly taken.
Actually, the related question is, somebody's asking, I plan to top up my portfolio. In that case, how do you decide on the ratios?
Sure. So, see, at any point of time, we maintain a model portfolio which we believe gives the best risk reward to our clients. When you do a top up, the top up will also go in a model portfolio allocation. So as a result, the top up will mirror your existing portfolio. And as I said, if there had to be any change in the model portfolio, it would have already reflected in your existing portfolio, and your top up will come in the new list of stocks.
So this is a valid question. Asian Paints earnings growth is only 14% in the last 7-8 years and not 25. How do we justify that?
Right. So, see, what has happened is, and this is quite interesting, good you asked actually. If you read our books, right, our books talk about a robotic approach towards portfolio construction. The robot says higher than 10% revenue growth each year. FY19 was one in a 20-30 year event for Asian Paints when crude oil prices, they fell from $100 to $30. Asian Paints took a 6% price cut. And as a result, despite delivering a 12-13% volume growth, its revenue growth was down to a mid-single digit level, right? We know how temporary and how exceptional this event was. If you look at the earnings compounding of Asian Paints, actually you'll see it's not that 14-15%. The earnings compounding of Asian Paints is in the 20-22% zone. Revenue compounding reduced because it took price cuts. The pricing power allows it to take price hikes when $30 crude becomes 100, and when the $100 crude became 30, it did take price cuts, and that had a drag on the last 3-year CAGR or 4-year CAGR that you're looking at. There is no other reason. Volume growth did not drop down to single digits. Volume growth is still in the double digits for the same time period that you're talking about. And hence, nothing has changed really in the fundamentals. It's an optical moderation in revenue growth. Earnings growth still remains strong. Going forward, even revenue growth will be normalized to 18-20% levels. So this year, for instance, it has grown volumes at some 21-22%, and last quarter 21-22%, and revenues at some 23-24%. So you do have a little bit of volatility like that. It's okay.
Okay, so the next question is, what returns will Marcellus aim to achieve over the next 10 years?
Post expenses and any fees that you pay us, you should expect 20-25% compounding. It could be 20-21%, it could be 24-25%. We are giving you a range, 20-25% compounding on the portfolio over any holding period longer than 3 years. You don't even have to wait for 10 years. Any holding period longer than 3 or 4 years, we expect you to get a 20 to 25% compounding on the portfolio.
Okay. One stock has just 1% weight, which is Cera Sanitary Ware. How come? It's very much unlike your concentrated approach.
Yeah. So when we sold Groove, we are still working on Cera. We took that small position because our conviction levels are not there yet on Cera. At the same time, so once the work on Cera is nearing completion, once the work on Cera is completed, if we want to hold it, given the liquidity, we still might not be holding a 9, 10, 11% allocation in that specific stock. So it'll remain a mid to low single digit one. At the moment, it's more of testing waters type of an exposure that we've taken. No other reason for that.
Okay. There's one specific question on Page. On Page, the company cut its disclosure in the third quarter results in terms of segmental volume and revenues. Does this concern you?
Right. So if you really see, Page's disclosures historically used to be across too many segments, both on volume as well as on value, done on a quarterly basis. So pretty much the maximum amount of disclosure that you can expect any company to deliver. Now, the explanation that the management has given is that this obviously keeps them in a disadvantageous position compared to their competitors, because competitors get every sense of what's happening to Page's portfolio, but Page, or for that matter anybody else, doesn't get a sense of any other player in the industry what's happening to their mix of products and growth rates. Do we believe in what the management has said? Well, yes, certainly. This is the reason why some of our portfolio companies actually don't even do any sort of disclosures on their segmental numbers. So Nestle doesn't even do actually conference calls, meetings, no extra reporting beyond what annual report gives you and what is a statutory requirement. In such situations, rather than going by the analogies of whether this is a good practice or a bad practice, our approach is dig deep, understand, is there anything that we should be concerned about on Page's fundamentals? That's the exercise we've done over the last 6 months. As a result, regardless of whether they disclose or don't disclose segmental revenues, we, with our team of analysts at Marcellus, are 100% comfortable at the moment about the segmental compounding or the segmental growth rates that Page has already seen over the last 3 to 6 months. And hence, we are not worried about Page hiding something by not disclosing to the broader market. That's not the worry that we have basis the work that we've done. If we get any signs of concern on what we hear from the ground level checks that we keep doing, then certainly your point is very valid. Discontinuing disclosures on segmental volume growth rates at a time when your fundamentals have gone through a little bit of moderation recently is something which is not a very comfortable thing to do for the broader investment community. But we are not concerned at the moment.
You just get this last question on Page out. Given the movement of the stock during the quarter, it's unsurprising that we're getting so many questions on it. A specific question about the rapidly organizing nature of the undergarments market and the low representation in Offpage in the women's market. What are your thoughts on it?
So to begin with, let me put it this way: women is a lot more technically complex product than men in the innerwear space. Within men, the vests are a lot easier to manufacture. Lowers, which are underwears, are more difficult. When you look at women, it's even more difficult than men underwears. On top of it, women, number of SKUs, the utilities of different SKUs are very different. So fashion wear versus all-day comfort versus sportswear. You would have different SKUs for the tops and the bottoms in the innerwear segment of women. As a result, you've already not seen a Triumph or an NMR do comfort wear. Historically, you did not see Page do fashion wear. Most of the Rupa, VIP, Lux, Amul Macho, these companies, they don't do women altogether, right? So because of the complexity of the product, the range, the different utilities, etc., Page for the last decade or so has been limited to a very small part of women's wear. Over a period of time, it is expanding its portfolio. So there are a few fashion-oriented products launched recently. Obviously, the brand will also have to keep the brand recall transitioning towards a broader fashion comfort oriented offering, which we'll have to wait and see if they continue to do that transition. But that's one main reason why, despite the fact that Jockey has been around for the last 25 years, its presence in women is very small, I would say. The market share in overall organized women is hardly 8-9% at the moment. But that's also an opportunity in many ways because it's a fast growing category. Women is also going to be the larger of the two categories between men and women. And if Page continues to grow in a disciplined manner across different types of products, I think this is a very big opportunity here in the future.
Okay. There's several questions around one single theme, which is around the sector. I think what we've addressed so far is why do we have so much exposure to paints? But the other side is, people are asking, how come there is no IT or pharma company in your portfolio? And related to that is questions around what prospects do you see in pharma, what prospects do you see in asset managers and all sorts of sectors, and also specific questions about companies. I think the company-specific questions we'll avoid, given there's no limit to it. But we'll try and address our approach towards sectors. Rakshan?
Sure. So see, the whole approach is that we want to buy into companies which have a unique DNA that overcomes disruptions and evolutions, and hence, without much volatility, gives you a 20-25% earnings compounding. Yeah. When you look at IT and pharma, they have had 10-15 years of TCSs of the world or of Lupin Cadellas of the world delivering a very consistent, very robust, long-term fundamental growth. But given what's happened over the last 3, 4, 5 years in both these industries, right? In IT with digitization, with cloud computing, with a few other areas of disruption, and at the same time on the pharma side with consolidation of the US distribution channel, where from 10 or 12 distributors it is down to only 3, and that leading to price erosion in the sector. The nature of disruptions that IT and pharma have seen, unfortunately, even the TCSs or the Cadellas and Lupins of the world have not been able to overcome these disruptions in the way that we would want them to, right? At the same time, our conviction levels on whether over the next decade they'll deliver a 20-25% earnings compounding without any volatility is not, the conviction levels are not very high at the moment. So that's one reason why, I mean, you extrapolate this and you will go back to the airline and telecom. I'm not saying IT, pharma are anywhere close to airline, telecom, but extrapolate it to a very large extent and you get to airline, telecom, which are sectors that are growing, companies that are dominating, but the nature of the competitive advantage doesn't let even the leader to make any money, right? So now, again, IT, pharma are not those candidates yet, but they've become the type B companies now. They've become the Marutis, Unilevers of the world, we believe, for now. If we think we do keep them on the radar, so something like a Divi's and Abbott Labs. I mean, you would have one or two other IT companies as well. They are part of our coverage universe. They're not part of our holding portfolio yet because our conviction levels of them being able to match the quality of an Asian Paints or an HDFC Bank isn't there yet.
Okay, so there's one question around Group Finance, which has been the only exit in the portfolio till date. Question is, will Group Finance make a re-entry? If yes, what situations?
So let me summarize the competitive advantage that we understood of Group Finance when we held it. It was the most disciplined and cautious lender at the ground level in the subprime mortgage category. So subprime means you don't have a CIBIL score to rely on, you don't have a historical track record of salaries, of loan repayments, etc. to rely on for the borrower, and still you are lending you're lending to that borrower a sizable amount, right? The beauty of Group Finance was that over the last 2.5 decades, it had not lost the discipline of expansion. To the extent, just think about it, not only was it the most efficient player with 30% ROE, since 2006, for the last 13 years, it didn't do any capital raise despite maintaining a 1/3 dividend payout ratio. So it maintained a healthy dividend payout ratio, but internal accruals were good enough to fund a 20-25% growth. Right? Compare this to everywhere else in the housing finance sector. They would raise capital, go bonkers on expansion of loan book, and then after 5 or 10 years, you see NPAs coming on the books, right? Now that discipline, we believe, if Bandhan Bank leads to a very rapid expansion geographically of Gru's loan book, because that's what we in a way understood from the synergies, quote unquote, that Bandhan Bank was talking about after the acquisition. If there's a rapid expansion of geographies of Group Finance's loan book exposure, there are going to be doubts on the ability. Obviously, Gru might still do very well, but the probability of it doing well consistently, the way it had done over the last 2 decades, will be reduced. On top of it, obviously, we love the quality of the board on Gru, on management, etc. And that is where we'll have to rebuild confidence in Bandhan's management team. At the moment, we don't think Bandhan's management ranks amongst the top 10 management companies for the country, and hence it's not part of our 10 stock portfolio. That's the reason why we chucked it out. But I mean, we might 5 years, 10 years later realize that this is a beautiful company, in which case we'll keep considering that in future, but not as of now.
Okay, another common question is about our philosophy of selling. I think Gru is one example, but in general, people would like to know how do we decide when to exit a certain position?
Yeah, very good question again. So Gru was one example where overnight our conviction in the moat reduced and we pressed the sell button. The second type of an example could be, hypothetically speaking, let's say after the HDFC Bank's current CEO retires, right? We'll keep our ears close to the ground. Maybe it remains an institutionalized, a very beautiful story, which we believe it will, but maybe that doesn't happen. Now, that could be a very gradual drop in conviction rather than a sudden drop in conviction, which we saw in the case of Group Finance. If it is gradual, we might not press the sell button too soon. We might actually press it 3-6 months later, 9 months later, after the share price has also started falling. We'll see when the conviction levels drop, and we'll press an exit. Apart from these 2 reasons, we don't see any other reason why we would sell a company, barring one very hypothetical reason. Let's say if we believe that Asian Paints' fair value is 100 times PE multiple, and at 100, if we were to believe that it truly factors in the longevity of growth, and the valuation goes from 50 times to 300 times, right? So hypothetically speaking, we will press the sell button based on valuation, despite the company being very beautiful. But so far on our portfolio companies, we don't see that point approaching anytime soon. And hence, that reason for selling is not likely to happen in the future.
Okay. Again, several people coming at it in different ways. The point being that there is a feeling, there's a belief that earnings are going to decline over the next 2 odd quarters. What is the strategy when such a thing is evident?
Earnings are going to decline for the broader market, or?
Yeah, I presume it's for the broader market.
Okay, so let me quantify something here. So FY15 to FY18, Nifty EPS CAGR was minus 1%. Yeah, so FY15 to FY18, Sensex Nifty delivered a minus 1%. No matter which other index you take amongst the large and mid caps, answer would have been very similar. Our portfolio companies delivered 18.5% CAGR over that period, and as a result, when I was running this philosophy in my previous avatar, we ended up getting a very healthy absolute performance. I mean, you can look at the performance numbers there. I'm sure you are aware of the product which I'm talking about, and you can also see the relative performance. So it is true that a year like 2018 happened because there was no fundamental support to the rally that broader markets had seen in the preceding 2 or 3 years. And as a result, the question is very valid. What if in the next 2 or 3 quarters, again, there is no fundamental profit by the market? We believe that doesn't apply to our portfolio. And if our belief is true, then the share prices won't be disappointing you, both in absolute as well as relative terms. So hence we continue holding, despite such a possibility of weak fundamentals in the future.
Next up, NRIs have the question that I guess they don't see Page in their portfolios. I think it is worth explaining why the difference in the portfolios for resident Indians and NRIs.
So it's an unfortunate thing. Page has crossed the NRI limit that the regulator has for NRI. So for every stock, there is an FII NRI limit that the regulator defines. We have to obviously abide by that. We can't buy Page for any NRI portfolio till the time the limit remains breached. At the moment, it is breached. As a result, we've got a substitute instead of Page, which you see in your portfolios.
Right. So there are a few, I think, sort of housekeeping questions about the fund. One is the performance fee. Will it be the same or different for different ticket sizes? Yeah, I mean, in general, it is the same. We don't have any difference. For boxes north of 5 crores, we do have some sense. Remember, the performance fee is not just to deliver the investment returns, but also the sort of client servicing infrastructure we're putting in place. So beyond a certain corpus, of course, it makes sense for us to look at reducing the ticket size. And the corpus, as of now, is 5 crores for one to avail of a lower performance fee offer. So the question about what is the current corpus? Current corpus looks like we'll close March at about 100 crores in assets under management spread across about 150 investors. This is 3 months since the start. We started about mid-December, and yeah. So those are some of the specific questions we're getting about the fund. There's also most often repeated question, I guess, given the situation in the marketplace, which is, are there any plans to start a small and mid-cap PMS? I'm sure this is coming from the events in the marketplace over the last couple of weeks. But why not? Of course, at some stage we will be able to. I mean, we would love to add value to clients' portfolios through a small cap product. But it'll all be in good time. Like you might have realized, we're not big fans of timing the market, and hence we're not particularly excited that yes, small caps are on it here. This is the right time to launch a small cap product. We will do it when we have the bandwidth to justify investing in a new product. As of now, all our energies are focused on delivering returns for the consistent compounders PMS. Someone's asked, is Saurabh part of the investment team along with us? Yes, of course, he is. Unfortunately, he couldn't be with us today as he's traveling. But yes, he remains the CIO of Marcellus Investment Managers. Rakshit is the portfolio manager. Along with Saurabh and Rakshit, I joined them on the investment committee in terms of taking all crucial decisions about the portfolio. So he's very much involved in the entire research and investment process as well. So I guess we've tried to address as many unique questions as possible, but looks like we've run out of questions. We'll try and make this call available to you on the website. The recording will be available, and we'll try and summarize all the questions and put it together in a note and send it across to you so that all of you can benefit. If there are any questions you felt haven't been addressed during this call, please feel free to shoot us an email or give us a call. You have our numbers, and hopefully you've received the welcome kit with the login and password details to the portal. If you haven't, please give us a shout. Happy to find it in the mail and send it back to you. It is important, like we said, that people, investors in our fund, understand what we do, why we do what we do, and have full access to information and transparency. So that's pretty much the basis for this call. But if like I said, if you think that there has been a question which hasn't been addressed during this call, we are more than happy to address it and circulate it amongst the participants. But thank you, folks. Thanks for joining us on a Saturday morning. Appreciate the time, and hopefully we'll reciprocate through our performance. Thank you so much, and have a great weekend.
Thank you. Thank you.